Good morning and welcome to In the Room with 91. I am your host, Arifa Essop, and today we are chatting to Rob Forsyth, Equity Analyst at 91. Hello, Rob, and welcome to In the Room with 91. How are you today?
I'm fine, thanks, Arifa. Thanks very much for having me.
That's great. Rob, you've been with 91 and in the industry since 1995. Tell me why the decision to be with 91 or and asset management for that matter. Why asset management? Did it pick you or did you pick it?
Ooh, I've got to say, it probably picked me, I must admit. I mean, I suppose I was lucky enough as a little kid. I used to spend some time with my grandparents, and my grandfather was a bank manager. He was quite very conservative. It was all about getting your money back. Whereas my grandmother was the wild one. She used to follow the shares in the newspaper, and she used to make some money on gold shares, as we all still try to do nowadays. She used to pick clicks and a couple of things. So I used to have some chats with my grandmother. And I suppose I was lucky enough also to visit London when I was about 17. And I remember distinctly going to the Lloyd's building. At that stage, it was a very avant-garde building. It actually had all the service elements of the building there. You could see them, and they were on the outside of the outside of the building. And I just remember the energy of, I suppose it sounds crazy, lots of people walking around in suits. But I enjoyed that sort of energy. So I'd done finance and always enjoyed numbers. So I enjoyed that and did that at university. And quite frankly, when you came out of university, I didn't know the difference between a merchant bank, a corporate bank, an asset manager, a stockbroker. I just knew I was interested in sort of finance. So I sent off my CV to a whole bunch of companies. One of them was UAL, one was Standard Corporate and Merchant Bank, and one was Investec at that point in time. And very distinctly remember going up to 55 Fox Street and actually having an amazing opportunity because they ran a graduate placement program and speaking to all the heads of divisions of Investec and the interviewing. And my last interview was actually asset management in Cape Town. And being a Cape Town boykie, I was kind of quite keen to go to Johannesburg. That was where most of the action actually took place in South Africa. Well, I perceived at that point in time, and actually ended up getting the job at what was then Investec Asset Management, and never really looked back. It's such an amazing industry in terms of if you like to learn, your learning curve is extreme and very, very fast. I remember I learned more about accounts, economics, and stats in the first 6 months of working that I'd learned in 4 years of university, I would say. So intriguing, and it's amazing what it gives you the access to, which is, as a youngster, is incredible. So you learn a lot about companies, because at that stage the industry was growing quite nicely, and we were. At that stage, we were like an up-and-coming asset manager. I think we only managed about 15 billion rand at that point in time, which is still, we were on the growth path. And that allowed you to meet all of the top business people in South Africa, on a basis when they report and they come through your offices. And that's amazing.
That is.
To learn about all these different businesses. So I'm fascinated about businesses and business models and how they're put together. And we still run graduate placement programs and have young people come through the offices. I often describe it to them. It's like doing a sort of a 3D puzzle. So, you've got your puzzle pieces, you've got to try and put it all together. You've got to try and make sense of the financial world, of markets, of equities, of all the different asset classes. But just as you think you're getting it right, some giant comes in and actually takes all your pieces and throws them to the four corners of the room, and you've got to try and rebuild the puzzle.
Or that piece has fallen down and you can't find it and nobody knows where that piece is, right?
Exactly. So you've got to rebuild your puzzle, and that's what the markets do to you. So as long as you've got, let's say, a fascination and a curiosity of the future, it allows you to learn so much. So that's absolutely amazing. And then obviously being part of an organization such as 91 has been an incredible journey because, and I think we can see it when we look at shares as well. We like to have shares that grow. And I think if you have a growth mindset, it's very important in a people-orientated business. So, because it gives you scope to change your career, to do different things. And as a result, we were growing, we grew nicely. And, I got a chance to do incredible things, chat to clients from a very early stage, got a chance to run portfolios, to be an equity analyst. And
Talk about that.
yes.
Equity analyst, not portfolio management. What's the difference and why did you choose?
Well, I've done both. And I think it's actually, it takes quite a long time for you to work out what you're good at. Everyone wants to get in and be a portfolio manager because that you see as maybe the glamour, but with it comes the stress as well. So it takes a while to work out what your strong points are. So I'm very good at ripping companies to pieces and trying to work out where they're going and working out what they're worth and whether they'd be good inclusion to a portfolio. But the portfolio management skill is really putting together a story that makes sense in a portfolio context that controls the risk and delivers the right attributes for your clients, which I'm not necessarily the best at doing that. So I let someone like Clyde do that, or let him. I mean, he's the person who's very good at doing that, So people are different skilled in different ways. So it's about knowing where you want to be in investments, I think, and then trying to grow with that. And luckily, in an organization such as 91, you've got the scope to do both, which is fantastic, or be involved on the client side or the marketing side, or, and from a global perspective, it's so exciting because we fully integrated global team, which, we competing with the biggest and the best of the world. And that's really exciting. So you get your competitive juices going, got the ability to compete, and, that's very exciting.
Excellent. So many investors tend to have a home bias, so they favor local investments over global investments. And we've heard this a million times. South Africa forms less than 1% of world GDP. How do you manage that or the message when you're, from your perspective, in terms of the client's financial goals?
So I think, we blessed once again that we're part of a team. While, we're talking a little bit more about the Global Franchise Fund now, but we also run other funds. So we actually have a fully sort of sustainable asset allocation process. So that's really, in an unconstrained world, where would you put your money? And, there's a lot of factors that go into that model. A lot of them is expected return. A lot of them is volatility or the risk that you might take in different asset classes. And at the moment, our models still say on an unconstrained basis, you should have circa 65 or 70% of your assets outside of South Africa.
That high?
Which is still higher than the 45% that we allowed to take out, and that's been a journey. It's sort of at 5, 10, 15, 25, 45. So we've been moving in the right direction. And if you think about it, it's really about trying to access different opportunities to invest and to be able to deliver the same return with lower risk or higher returns with the same amount of risk. That's what you're trying to do. So you want your pond in which you fish to be as big as possible. But importantly, and what we found at 91 is you've got to do that in a systematic way. You've got to stick to your knitting in the way that you like to invest to be able to access those different pots of return. And then you've got to build a sensible portfolio around it.
I want to go back to the 65%. And a lot of research says that usually that used to be 70 local, 30 offshore, which brings your risk down slightly. How do we get to 65?
So a couple of things have changed. When I first started, the mantra was you bought South African equities and you'd have global treasuries, mainly US bonds, if I can put it that way. That gave you the best risk return diversification. Actually, if you look at how correlations have moved over the last number of years, it's now actually you want to have most of your money in South African bonds, and you want to have most of your money in offshore equity. So the way that we get to those sort of numbers is, and it's important now, this is not necessarily investing in a passive way in the index, it's the opportunities that we identify as the quality team at 91. So, you know, if I looked at it and you went very frankly, if you looked at US bonds trading at around about, let's say, call it 4%, round up a little bit, SA bonds round down a little bit, round about 10%. That's a 6% spread. It would take into account more than the normal expected rand depreciation. It shows that there's a bit more risk embedded in South African bonds. It still gives you a nice real return. So that's a fairly, fun return profile to be able to access. So that, you shouldn't throw that to the wayside. But importantly, you've got to be able to deliver better than that in equities with the commensurate amount of risk. And that's where we try and spend quite a lot of our time, is concentrating on that risk portion.
So how do you see the global franchise feeder fund fitting into a typical South African investor's portfolio?
I think we've got to give us a little bit of history here. So I think it was 98, we could first start taking a little bit of money offshore. And that had to be done by an asset swap. So actually, if people might remember that maybe a lot of the asset managers didn't have at that stage too many cash funds. Now, the reason you had a cash fund also was to give you better asset swap capacity, because it actually worked on a manco level. So if you were managing a lots of unit trusts and you had a large money market fund, it allowed you to take a little bit more money offshore for a balanced fund or a multi-asset fund. So that's just to bear that in mind. It's interesting that people from a very early age recognize that, taking 5% offshore is not the right amount. Okay. Then we thought about, well, let's look at the makeup of the South African exchange. Mining. I think when I first started, I think there were 30 gold shares listed. Number of mining houses. The JSE fluctuates between probably 25 and 45% sitting in resource-based counters. And the other naturally strong point of South African business is the financial services. So we have good financial services, well-consolidated market, but once again, banks and financial services making up also quite a big proportion of the index. Now, so we've probably got 60% sitting in financials and resources. That is a fairly volatile cash flow stream that you can access, particularly resources. Anglo-American, if they're going to build a copper mine, which is all the rage at this point in time, they're going to add to Los Bronces. It's going to take them 5 years. It's going to spend $5 billion. They're going to have no idea what the copper price is going to be in 5 years' time. That to us is quite a risky endeavor, and your cash flow can go up and down and can be very, very unpredictable. Typically, financial services, the work that we would do would show that globally, they've got, if you're top of your pops, if you're a JP Morgan, most people recognize that, one of the best global banks, you've actually only got about a 30% probability of being one of the best performing banks in 5 years' time, which is quite low. And if you think about it, it's because the market's very fragmented, the deposit base very fragmented. You're leveraging, you're taking quite a lot of risk in terms of that environment. So we saw, 60% of the JSE having quite a lot of risk embedded in it. So what we wanted to do when we went offshore, first of all, was to minimize the volatility and to try and enhance the returns. So naturally, then you would be drawn to areas that you couldn't get exposure in the JSE. So something like healthcare, some of the consumer staples, the consumer discretionary names, media names, some of the information technology names. So all of that was a different type of exposure, which are large parts of companies and growth that you couldn't access. The difficulty in doing that is you couldn't leverage off your South African skills base. You couldn't go, well, I've looked at Anglos for, a decade. I know when it's a good time in the cycle to buy Anglos, and therefore I'm going to go and buy Antofagasta or Rio Tinto or Vale or Nippon Steel at the same time in the cycle, because you're just doubling up on your risk, essentially. So we built a skill set then in looking at different types of companies from scratch and embedding it into our investment process, which has obviously been great on the learning curve. So, we know a lot about, healthcare companies, IT companies, consumer staples companies, consumer discretionary companies. And that was a very thought out process for the South African investor to minimize the risk and to maximize the return. And funny enough, because we're a global asset manager, and actually in the global franchise fund, less than a fifth of the assets actually come from South African investors, it's actually proven to be quite a popular strategy in the likes of Australia,
Okay.
Canada, even South America. Now you think about it, they're also quite similar in many ways. Australia, mining resource base, Canada, mining resource base, strong financial services, also lacking that interplay with the way that they can invest locally. So we see it as a very, the global franchise as a very core building block in minimizing your volatility and trying to maximize your returns throughout a long economic cycle.
And I guess to get exposure to those assets that we wouldn't really have here in South Africa, as you've articulated.
Yes, no, I mean, I suppose a wise person said to me once, if you wanted to hedge out some of your risks as an individual, maybe it's good to invest in the best companies that you can get access to. So, if you're worried about healthcare and your risks as you get a bit older, maybe you should invest in some of the best drug companies in the world or some of the best hospitals. Luckily, we can have access in the JSE to invest in hospitals. If you're worried about your costs of information technology going up because they've got strong pricing power, well, maybe you should invest in the likes of something like a Microsoft, because then you win every time they put up their Office 365 package. So, there are different return profiles that you can access. So we think that that's pretty important.
So let's talk a little bit about diversification. When we think about diversification, some people think just fund diversification, but in global investing, there's currencies to consider, there's sectors, there's geographies. But are there any unconventional sectors that South African, or not necessarily sectors, or overlooked ways to achieve diversification for a South African investor?
I always find this diversification quite interesting, because if you said to me, well, the USA, it's 70% of global markets at the moment, shouldn't we invest away from the USA? But I mean, 50% of the S&P's earnings come from non-US sources. So diversification by geography doesn't make a lot of sense to me, because it's really about where the companies generate their revenue. So Nestle, which has been a consistent holding of ours, hasn't done so well recently, but it's performed admirably over the last 30 years, is the fact that it's in 250 countries around the world. I don't have to worry about the currency. It has got pricing power in all of those areas. So we don't spend a lot of time thinking about geographic diversification, because the companies do that for you. I think what's important is business model diversification. And by that, I mean, we tend to stick to our knitting. We like to have companies that generate very good returns, where you go to sleep at night, that they've got a very high probability that they will continue to grow, that become more valuable the longer you hold them, that are great companies that invest behind their products and have got opportunities to grow. But there are other elements of ways of investing. You might want to have a value style of investing or an early stage business model investing. And I think it's more actually appropriate to diversify your equity portfolio by philosophy or by business model stage, if I can put it that way. So we try and have, a bit of what we might call more rocket fuel in the portfolio, stocks that are going to grow very, very fast. The bankers that have been around for ages, that have been around for 100 years, that we think offer great value, continue to compound. And then the sweet spot of companies where you can probably back them, where they've still got quite a lot of growth left in them, which are very good. So we try and diversify a little bit by business model stage, which I think is more appropriate.
Okay.
And maybe just a shout out as well to our SA client base is that, I mean, I'm fortunate enough to travel around the world, and it's interesting. You go and see lots of people. So I remember going on a trip to the United States, going to speak to the Oregon Pension Fund, $80 billion, one pension fund. And they were bemoaning the fact that they had pretty much subpar returns because they outsourced their asset management function to 100 players. And you think, well, they had no idea about how different portfolios perform compared to other asset managers or other investment philosophies. And that's the most important thing. If you can find diversification of asset managers who can actually stick to their knitting and what they're trying to deliver, that's when you get like good long-term performance. So funny enough, even within 91, if you look at the Global Franchise Fund and you blend it with our four-factor equity, you actually get very nice risk because we give different return signatures in different environments, which is always good, and you got to try and minimize your risk.
Okay. So, and I'm looking for an opinion here. Okay. You're finding that more and more countries are protecting their own economies. Examples would be the trade wars between US and China, the COVID-19 pandemic. Is there still opportunity in global investing going forward, or do you think that that's going to change?
I think you have to be careful. So, we've kind of grown up a little bit. Geopolitical risk, what geopolitical risk, whether it be, we've had lots of events, maybe the Twin Towers or the Iran war or the Iraq war, where markets have reacted for a little bit, Brexit, and then they've just sort of powered ahead and kind of ignored this. I would say there's enough evidence to suggest that you have to think about geopolitical risk. I think when it comes to portfolio construction, then we try and be careful about the linkages that are formed. So you don't want to have companies that are too reliant on a non-diverse supply chain. So, for instance, like semiconductors is a very interesting field because it's right at the heart of some of this kind of, let's say, trade war between the US and China. So it's quite difficult to unravel that. So our semiconductor exposure in the fund is a little bit in Samsung, which is a smaller weighting, which is a leader in global memory. But clearly that's got its own foundry. It can produce its own chips, its own handsets. It outsources to third parties as well. It produces memory for third parties and is based in Korea. So, it does have some Chinese factories, but we'd say that's relatively low risk. Something like TSMC, you can see a lot of opportunity there, but it is at the moment sitting on the island of Taiwan, which, one blockade around the island of Taiwan and Apple does not get any chips, NVIDIA does not get any chips. That's an issue. And that's why you can see they're building factories around the world. So they're building 3 in the United States, 1 in Japan, 1 in Germany. And that's try and get rid of that supply chain risk. We've got a holding in ASML, which is a very interesting company. Basically, you can't make the latest chips without using ASML. Now, they benefit from people putting up more factories because people are going to use their equipment. But they do have some exposure towards China and the older technology, which, increasingly the screws are being tightened. So you just got to be careful about the way that you build portfolios. I would say typically the shares that we invest in tend to be bigger and they already tend to be globally relevant. And I think if you threw the gap, if I can put it that way, you threw the door of being globally competitive, that's a big advantage because it's going to be harder to do that in the future. So we think that scale is going to be advantageous in the future. So it's all about trying to control your risk in the portfolio and making sure that you're not taking undue risk.
Okay, so let's talk about currency risk. Currency risk comes up very often when we are talking to South African investors. How does one use that to work in your favor? And what should investors be thinking about when they're worried about currency risk?
I think what's interesting, what we've found also once again running the multi-asset funds is once again risk and return. So what's your return that you get from currency? Generally tends to be quite low. So it's in kind of finance terms, it's the difference between the interest rates. In other words, the rand would tend to, let's say, depreciate against the dollar by the differential in interest rates, because otherwise what people would do is they'd go and put their money into the other currency and they would just earn the higher interest rate and they could sell it forward. So at the moment, you sort of get about a 3% guaranteed return from the rand. Now, that is very volatile. Okay, that moves around all over the place in terms of the actual rand dollar exchange rate. So it tends to be more volatile than even equities or particularly from bonds. So as a result, the best way we found actually to control some of the risk is, now it gets a bit complicated, is to sell sell the dollars forward. So essentially you guarantee getting a 3% depreciation in the rand and then you take out the volatility of the rand, which actually helps you control the risk and return in the portfolio very, very well. So that's the kind of the strategy that we adopt. But then ultimately it comes down to the individual assets, and you've got to be able to have a philosophy and investment team in place that can actually have an idea about what the expected return of assets are. So we know from, let's say, once again, when I get back to that sort of 65 or 70% offshore, is that we have a slightly, for the assets that we can access, we still think that you can get a slightly higher, a similar dollar return to rand-based return for equities. And as a result, you're getting much better companies with much better risk parameters, and you're getting the rand depreciation a little bit then potentially for free. So that's the way. You need to be able to have a view of expected return and risk, but you remember that you can kind of sell the rand forward and you can guarantee a 3% return from that, which is quite not bad.
So apart from that, do you use any other hedging strategies, innovative?
No, you pay the banks too much. You pay the banks too much. So no, it's interesting that, because a lot of these derivative strategies you would look at and you price, but when you have to price it in the marketplace, the banks like to make a fat fee. So we don't like paying that fat fee. So we don't want to avoid making decisions. That's the most important thing. We shouldn't have a hedging strategy to avoid making a decision. It's got to be to control risk, and it's got to be aligned with your decision-making process. So we will never use like derivative strategies to get rid of risk unless,
Feel strongly.
you got to have a view.
Okay.
Yeah.
And okay, so this is for Rob as an equity analyst. Global markets and themes are changing dramatically all the time. How do you keep ahead and know what those themes are and stay in touch with all of these themes and trends that are happening globally?
Well, I mean, you get a deluge of information coming at you. So it's important when looking at equity markets, particularly, to try and filter out the noise. So luckily in our area, we have a fairly disciplined approach to learn what we want to learn about, first of all. So, if we look at the global stock market universe out there, maybe 32,000 shares. Okay, we need some liquidity, so you can filter it out on a bit of market cap and liquidity and get down to maybe 5,000 shares that are really applicable. And then we know that we don't want to take risk in certain industries. And then we filter it down and we get to probably about 800 shares. And from there, we can start doing some deep dives on some of the shares. And, because we've got, let's say, 15 people on the global portfolio dedicated looking at this, we've got a lot of research coming in all the time. So it's most important to read your internal research, first of all. And I think it's important also not to get FOMO. Our portfolio is there for a reason. It's there to hopefully consistently deliver upper single-digit dollar-based returns, which we think will be very competitive globally. And it's to focus on improving that portfolio. So first of all, you can focus on trends by not getting distracted, because you've just raised the point, Arifa, that, there's a lot going on out there, and then it's from that detailed research comes some interesting things. And a lot of the trends are maybe unsuspecting. So I'll give you an unsuspecting trend is outsourcing.
Okay. Tell me more.
You wanna back the outsourcee, not the outsourcer. Okay, if I can put it that way. So give you a simple example. Okay, I mean, let's say banks. Banks actually owned a network called Visa and MasterCard. And they decided, well, this is like, we don't really want to hold this anymore. We'll make some money and we'll put it all together in a company and we'll list it off. Visa now has a market cap larger than any of the banks put together in the world. Okay. And that's because it's a far superior business. You've got to be careful a little bit. Now, what we've seen is, a lot of US companies can do very well out of outsourcing. So Apple doesn't make its own chips, doesn't make it makes its phones, but it outsources that to Foxconn. which then gives capacity. If ever there's a problem with Apple's product portfolio, Foxconn can obviously use that capacity to assemble phones for someone else. So that's a risk, and they're seeing that now in their supply chain. Also, if you look at pharmaceuticals, what's happened is that research and development has become a little bit more fragmented. So younger, smaller companies, people have left to form them, and they've been able to do that because they can outsource the discovery, they can outsource the testing, they can outsource the clinical trials, and they don't have to put a lot of capital there, and therefore they've sort of eroding some of the new discovery in new molecules for large pharma companies. Something like consumer staples. When we went into the global financial crisis in sort of 98, that crisis, the dot-com sort of crisis, we had a very, very large exposure in consumer staples. And over time, what you found is people, to try and improve their returns, have outsourced some of their production. And that becomes a problem, because then people can use that production for other people. New barriers to entry for people can get into the business. Marketing has become more fragmented, so you can't just control the TV channel. You've got to be able to do well at social media marketing. You've got to be able to deploy those dollars, and as a result, it's become more competitive. So you've got to be careful how you outsource. I mean, I'll give you a great example. Disney, Fox, Warner Brothers, Discovery. Oh, let's just outsource our old material to a little company called Netflix. It's old material. No one will really want to watch it. Now Netflix is bigger than all of those companies, in terms of market cap. So it's interesting. So that's like an obscure type of trend that you pick up from the way that you look at companies and you analyze them, just to be aware about what's going on in that. I mean, clearly there are trends that and when we do our research, we don't do our research because of a trend. We do it because it's we've identified a stock, and we tend to spend quite a long time, maybe month, 2 months, doing an in-depth report, looking at the individual company and putting it aligned to our philosophy. And there you start picking up trends. So we picked up that, software and services particularly was showing very good cash flows, very good businesses, subscription businesses, still had a lot of opportunity to grow. And as a result, there were more opportunities coming in that environment. So we managed to tailor the portfolio to putting a little bit more into software and services. We've also been, if you look at trends, once again, the consumer tends to be a little bit more fickle than businesses. So if you look at some of the exposure that we would have, it would tend to be more business orientated than consumer orientated. So those are the sort of trends that you pick up in terms of looking at different companies around the world.
I read recently that a lot of the companies you own are more than 100 years old. Tell me more about that.
So I think one of the proof points of sustainability is they've got to weather the storm, So the likes of, I've mentioned Nestle before, but I mean, Nestle has not sold less coffee. So, we haven't got a coffee on the table here at the moment. We haven't got an espresso or our normal granulated coffee that you get at the supermarket, but they've got, 25% of the global coffee market. They keep on innovating. They keep on managing to grow. They haven't sold less coffee. They haven't sold less water. They haven't sold less pet food. In fact, people love their pets. And we've got a little internal hashtag NBAP, never bet against pets, kind of moniker, because there's some interesting companies that you can access that got to do with animal health, particularly, whether it be Zoetis or whether it be IDEX, or, there's some elements there that have grown very, very strongly over a period of time. So, we need companies that can weather the storm. So Nestle, even since 1990, you consider we had a recession in 1990. Very interesting time. Why we called 91? It was, the Berlin Wall was coming down. It was the end of basically the dissolution of the Soviet Social Republic as well. It was also a very tremendous time of change for South Africa. So coping with changes is important. And, so we had Nestle had that. It had the Mexican crisis in 95. It had the dot-com crisis in 2000, 2001, global financial crisis. It didn't skip a beat. Sold more pet food, more water, more confectionery, more coffee year in, year out. So, there's a high chance when you've got a company that has had, not too many CEOs, a strong embedded culture, very strong market positioning, that they are able to grow and to be able to cope with what the world throws at them. An important thing is they've got a strong balance sheet, and that's very important to us. So, and it goes down to that original controlling the risk and the return. So Nestle has, in fact, it actually managed to place a bond. Now, a bond is a way that people borrow, where investors paid them a negative interest rate. Okay, so just think about that. How much money would you borrow when people actually had to pay you? That's a bit crazy, isn't it? Okay. So, but they didn't go crazy. They had a small bond which allowed them to do that. They give you, 3% dividend yield in Swiss francs, which is likely to grow. It's higher than Swiss franc bond yields. Very low risk, 250 countries. Lower risk than, I would argue, many governments. And that's going to be a very interesting sort of dynamic that we might see roll out. And we've had this debate before in South Africa. Are corporates lower risk than the government? Now, traditional finance would always say, not on your life, because ultimately the government can issue the paper. They can tax people to get the revenue, and they can issue more paper to borrow. But it's interesting with the state of the fiscal environment around the world, with the levels of debt going up all over around the world, high levels of fiscal deficits, you could make the case that something like a fully diversified corporate might be lower risk than some of the governments. But it'll be interesting to see how that kind of plays out. But hopefully that gives you a tune-up. We would certainly say that a corporate such as Nestle is lower risk than SA government, and it's been rated as such because of, if you look at the investment rating for SA, it's still in a sub-investment grade, whereas Nestle is not.
Do you think that phenomenon where corporate bond issuance is less riskier than government, is it a global trend?
Well, it's not at the moment, Arifa. So I'm just sort of positing, I'm sort of throwing out a little bit of a could it happen?
Watch the space.
Because it is interesting. I mean, if you look at, credit spreads, so generally investment grade credit spreads are kind of, call it 100 basis points. In other words, if you're going to borrow in US dollars, you're going to pay about 1% more than the US government. The US government has a horrible balance sheet at the moment, and it's getting worse, much worse than some of the corporates. So normal finance would dictate that always the government is the lowest risk. I'm just kind of throwing out not so sure that necessarily is going to be the case if you roll the clock forward 10 years or 15 years or 20 years. And that's interesting because corporates have to answer to their stakeholders, ultimately their shareholders, but they do have very other corporate, stakeholders. They have governments as stakeholders. They have creditors as stakeholders, they have employees as stakeholders, they have society as stakeholders. So corporates actually have to do a pretty strong balancing act of making sure that they appeal to different sort of constituencies within the financial world. And maybe governments could learn a couple of things from them.
Our government, certainly.
Well, let's see. I think we've got a government that's beholden to democracy, so that's fantastic.
That is true. So I want to talk a little bit about technology and artificial intelligence. It's taking the world by storm. Many people are getting excited about it. How do you see the interplay between tech companies and your traditional sectors like mining and healthcare or whatever it may be?
Well, I think you've got to remember that tech companies themselves are normally selling a service. And what are they selling? Software certainly they've been selling productivity. So the fact that we're on Zooms now, I think we are, that, that's amazing. That's more productive because people haven't had to jump in a car, go and travel to a big venue, listen to us have an interview. They can do it very efficiently. They can probably do a couple of things at the same time. If we're getting a bit boring, they can be looking at the markets. They can be doing a
In their
whole bunch of other things.
in their pajamas as
yeah,
well.
in their pajamas. But you can be more efficient with time, and that's ultimately what software does. So software is a productivity tool. So I think we've been quite careful in terms of trying to identify niches where that productivity tool is got longevity. So certainly, Microsoft is a stock that we've held since 2012. There's a lot of hype about AI at this point in time, but odds on, we'd say Microsoft has got the best opportunity to integrate some of the new technology into their products, and they've already done that with cloud. So if you remember, maybe I shouldn't say this, but how did you used to get your Windows? Well, occasionally you used to borrow the discs from your friend, your next door neighbor, pop it into your computer. So there was quite a lot of, let's call it, illicit use of Microsoft as an operating system. About 30% of sales globally at one stage happened via borrowed discs, let's say hard drive. But now, they moved to the cloud. So okay, I get a bit irritated because they instantly, you got another update for your Windows operating system that you have to download. But the point is they can keep the innovation cycle of their software right at the forefront because they can update it quickly, and that, cloud has been a big attribute for them. And now we've got Copilot. So, you can start using transcripts of meetings. You can start searching within them. You can start doing things which hopefully will improve your productivity. So software improves productivity. I think we've got to be a little bit wary. We have the luxury and ability to talk to a lot of people around the world. One of our large investments is Moody's, and our Moody's provides obviously a credit rating service, but it deals with data. It's basically a data information hub of proprietary data. And they say clearly one of the things that's important is getting that data to their customers. And they say when it comes to programming, there's massive productivity enhancements for someone who is organizing that data using some of these AI tools. So if you consider that software is going to become a lot more productive, will those companies be able to price for it? So that's a key thing. And who's going to, I mean, it's interesting that Microsoft has charged $30 for Copilot, whereas most people in the market thought it was going to be $9 or $10. So there's been quite a ramp up in pricing there. So we'll see how that plays out. So that element, you got to be careful about playing in the niches of software. Now, hardware typically in technology has had a little bit more of a boom bust type of cycle. We don't necessarily see why that's going to differ. Obviously NVIDIA is all the rage at this point in time, but there are some elements that is actually ultimately a hardware business. It does have some software that they very carefully build on top of their chips called CUDA. But really at the moment, and there's some competition brewing. So you've got these large language models, which everyone's trying to race to get to the next plateau. But ultimately, that's about 60% of the demand for the NVIDIA chips. About 40% is what's called inference, which is once you've built the model, it's kind of, asking you questions. Now, Google has some very impressive chips which compete with NVIDIA in that area. So, hardware, typically a little bit more circumspect about hardware. And then the bridge then into, say, a mining or an energy stock or an industrial stock is then how does it make them more productive? And does that upset the apple cart in terms of the positioning of the company? So typically we like to invest in companies that have good market share structures. We're talking 30, 40, 50% market share, bigger than the next, which it gives them economies of scale, allows them to invest a lot more in research and development. So, we just recently discussed a stock called Atlas Copco. Now, what do they do? Well, they actually, it sounds rather interesting. They do compression and vacuuming, essentially. So if you're in a factory environment and you use air compression for a lot of your tools, for any of your ceilings, that's very important. Now, does technology influence them? It only influences them to the fact that it might make them more productive, which is a good thing because they can put sensors, they can put chips in, they can then basically monitor all the equipment in the factory. They can provide service assistance to make sure that that crucial bit of equipment doesn't break down. So if you're on a beverage line and you are having to use air pressure to cap your bottles, and you use that because you don't want to use any other types of hydraulics or anything like that, you don't want any oil to contaminate your food, but you need to know whether that machine's going to go down. So you can put chips in the machine, it can measure the wear and tear, it can measure the pressure, and they can service it before it goes down, which because if the bottling line goes down, well, your brewery or your CSD or Coke plant has a big, big problem. So, you can use technology. So we are careful about where we invest in technology, but normally we would see it as an attribute towards the most of the companies we invest in because we're investing in companies that are leaders and then could use that to enhance their productivity, which they then use to put more money into R&D, more than anyone else, and to continue to be able to grow ahead of the marketplace.
So what I'm hearing you saying is that your traditional sectors like your mining and industry should be using technology itself to improve their productivity going forward. And that's where you want to play in that space more than anything else. Or am I getting that wrong?
No, I think you're saying, I think it all comes down to companies maintaining their market leadership. If they can do that, they're in a good position as long as they aren't behind the curve in adopting technology. That's going to be good for them. But I mean, to take mining, so someone like BHP is using a lot more technology. Once again, in terms of monitoring their processing plants, managing their fleet, making sure they upgrade it. But ultimately, what's the iron ore price going to be? They can talk till they're blue in the face about technology, but if the iron ore price is $100 a ton, $80 a ton, or $140 a ton, which is a bit out of their control, makes a massive difference to the economics of those businesses. So any amount of technology is not going to really dampen down the volatility of their cash flow stream. So that's something we wouldn't say, "Ooh, that's a great opportunity for mining." But, if you market leadership in a good position, such as Atlas Copco, and you can use it to enhance your service, which enhance your network, which gives you access to new products and new customers, that's going to be much more of a benefit. But you have to do it from a market leadership position.
Okay. So, and I hear you about the volatility, and I suppose that's important. And you've just articulated how we manage that volatility with any tech disruptions if that comes through. I want to talk a little bit about political instability, and somehow that always has an impact on your portfolios long term. How do you factor that into building your portfolio?
So typically, I mentioned a little bit about not really where the company is being listed, it's more where they derive their revenue from. So when we put together all the companies in the Global Franchise Fund, 28 companies, and we look at the revenue contribution, funny enough, it's not that different to what the index might look like. So we have about a 6% revenue contribution from China. We have about a 45% revenue contribution from the United States. Europe's a big pack. Emerging markets are reasonable. I mean, we may be marginally underweight emerging markets. I think when we last looked, I think emerging markets were about 28% of global revenue. And we're about, maybe 3 or 4% lower than that. So we use that as a bit of a health check, once again, to make sure we're not making a very big bet. So we're not that dissimilar to where indices are. The important thing is, do I wake up worrying about what the yen's going to do?
Do you?
No, not really. I worry a little bit about the carry trade and the unwind potentially on global markets. But from a company's perspective, don't really worry about what the yen's going to do because it's important that you have pricing power. So the fact is, if you look at, maybe an example of pricing powers, a company called Hermes, luxury goods company, is that they will just price in ultimately whatever they'll put the same price in around the world. So if the yen goes from 100 to 140 to the dollar, ultimately the price of a Hermes bag is going to go up. Birkenrad's going to go up by 40% in yen. But the point is they can do that. And they can do that because they've invested behind the brand. They've invested over 100 years behind that brand, and they've well invested as a company to be able to do that. So pricing power is very important. So we invest in companies that do have pricing power, and as a result, as currencies move around, they adjust their prices. So we don't worry too much about individual currencies. I would say, I mean, a couple of sort of tidbits, which is interesting, is because we run regional expressions of global franchise. So we've actually got an Asia Pacific franchise fund. We do have quite a lot of interest, let's say, in the Chinese market. And so we monitor the expected returns that we think we can get from investments. And now typically, if we wound the clock back 3 or 4 years ago, you would get a fairly similar, what we would call IRR, or expected return, from a lot of the top Chinese assets compared to global assets. But that differential's now started to open up quite a lot. It's probably around 3 or 4% extra. So in other words, let's say you thought you could get 10%, you can probably get 13 or 14% from some of the better Chinese assets. Now that's interesting. So it tells you that the market certainly is putting a little bit of a discount on Chinese assets. Whether you want to embrace that discount, that's a difficult task. I mean, we've got a little bit of exposure. We've got exposure in a company called NetEase, which is a gaming stock. But that's something that's of interest, if I can put it that way. And if you had to contrast that to India, which is all the rage at this point in time, if you look at the differential there, the market's really not expecting there's no risk built into India whatsoever. So it's just interesting how flavors around emerging markets change over a period of time. But we're very careful, because we've got to look around the world to try and access the best risk and return. So, have we looked at a lot of Turkish stocks?
Have you?
No, not really. We did an exercise a while back where we looked at a lot of emerging market shares, and unfortunately, the risk return didn't look quite right. So once again, to give an example on India, I mean, Hindustan Lever, which is the Unilever portion listed in India, trades on, call it a 50 multiple, 1.5-2% free cash flow yield in India, whereas the parent company trades on 17 multiples. So, there's a lot of growth built into that expectation. So typically we found actually that the straight emerging market stocks, their returns are not quite as good as on a company for company basis as some of the global stocks. You have to be a little bit more careful about corporate governance, and it's difficult to find returns that will beat some of the global stocks. So that's really how we think about currency and risk. And that risk, we chatted a little bit about it when it came to making sure that your supply chains aren't entangled, that there is going to be a bit more risk in the world. And it's interesting, we're seeing. So I've talked a lot about volatility now. That's a complicated word, but it's about basically how much things move around. And what's been unusual is that in the global context is we've seen bond market volatility higher than equity market volatility over the last couple of years.
That's interesting.
So that's normally because it's a more stable return profile. And that's because we've had almost a bit more economic risk, because we've had interest rates that have gone from nothing for 10 years to quite high, got it 5.25% at the short end in the US over a short period of time, which has introduced inflation volatility, economic volatility, and that's been seen in the bond market. I mean, I would probably expect that the bond market should settle down a little bit and go to, let's say, a more stable return profile, but equities then will become riskier than bonds. And the question is, can you get an extra return out of that risk compared to the bonds?
So, Rob, you've spoken a little bit about India. You've talked about Turkey. Are there any other regions you're finding that may be attractive or not so attractive?
As I say, we tend to look more at companies that have passed the first hurdle test of being as sustainable as possible. Now, sustainability is interesting in that, I mean, for us, it means you're basically got an aligned business model with a lot of the stakeholders. That business model is not ripping anyone off particularly, and it's got a long runway for growth. And normally companies that are interest us have got to a certain size, and there's a certain amount of proof concept in that. I mean, even if you take some of, let's say, even in South Africa, if you took like let's take Clicks for argument's sake. Okay, so Clicks, we can talk about Clicks because it's a stock that, everyone knows, and we've held it in our multi-asset portfolios in South Africa. So Clicks makes a very good return on capital, has benefited from the fact that they have driven scale at the pharmacy level and given customers a good value for money. It's grown very consistently and very nicely. But the point is, Clicks is kind of on the same price as Visa. So, and you're taking a lot more risk in a single geography than in a global business. So it's quite hard, to find the right risk return profile. So we tend to do it on a stock by stock basis rather than a top down type of theme. So that's why we keep on coming back. If you understand your philosophy and what you're trying to do, and you've got a team that can look at enough assets around the world, you can start, building up that picture that I talked about earlier without the giant, hopefully coming in and distributing your your pieces to the different corners of the room.
Okay. So success in global investing is not necessarily measured in great returns. How else would you measure the success of the global franchise beta fund?
I mean, yeah, it's a good question, that, because we are competitive, and there's a competitive set that we look at, but I think ultimately it comes down to looking the client in the eyes, and what have we said to clients that we're trying to deliver? We're trying to deliver participation on the upside. So if it's a great environment, there's a bit of chaos, there's a bit of go-go in the marketplace. On average in the past, because equities move around a bit, if it's a good environment, equities on a rolling 12-month basis are going up by kind of 20%. So we certainly in that environment on an annual basis on SA and in global. So we would expect to participate, get good, healthy returns, but we're not going to be, up there in the 20, 23, 24% if the market's going up 20. We're going to be more like 16, 17, 18%. Okay. But that's still very good return. Okay. But the important thing is when the rubber hits the road and you've got tough times and earnings are under pressure and there's risk in the market and volatility is going up and asset prices are struggling, that's when we look to come through for a lot of our investors and to deliver pretty steady returns when the market's lackluster or even down. And that, if we can continue to do that, it gives a very good payoff profile. So your chances of losing money in rands are very low historically. We've built up a track record of 17 years of running this consistently. And it's about looking your investors now and saying, that's what I'm trying to deliver for you. I'm trying to just be sensible here. I'm not going to chase anything. I'm going to deliver, hopefully, give or take, high single-digit dollar returns. That's going to be good in any inflation environment. You're going to lose out sometimes, but importantly, your downside risk is going to be pretty good. It's the old adage, if you've got 100 Rand and you lose 25%, you get to 75 Rand. You've got to get 33% return to get back to where you started. So it's about controlling that and building people's wealth over a long period of time. I mean, that's something we always, let's say, passionate about in 91. And I remember talking about the early careers. You always got, you always remember that there's a client. There's someone there who's desperately needs to save for their retirement, to make their life and their family's lives a lot easier. And that's becoming tougher. It's becoming tougher because we've had tough economic circumstances in South Africa, and we haven't had great asset returns. So if you look over 5 or 10 years, bonds, cash, equities have delivered somewhere 7-8%, give or take. Offshore equities delivered 15% in rands. So you needed to access that to be able to grow people's ability to retire. And now, we've got medical advances going on. People are not quite sure how long they're going to work, how long they're going to live. These are really, really big decisions. So, hopefully we can hold people's hands and deliver that for them And if we do that consistently, that's great, and, we're lucky to have a lot of clients that have stuck with us for a long time. And that's very gratifying when you've had a client with you for 23, 24 years, and you can say, listen, this is how it's built up, and this is the difference it makes in people's lives. That's what gets you out of bed in the morning. So it's about trying to stick to what you say,
Do it right.
and kind of do it, and just be sensible, Arifa. Just try and be sensible. I suppose we all want to be Usain Bolt, at the Olympics. Besides, he looks pretty athletic, but but he fastest man in the world, 3 Olympics, world record holder. That's incredible. But I suppose we'd rather be a bit like the Beatles. They can pop up. You can still listen to the Beatles. 100 years later, we're not quite 100 years past the Beatles, but Usain Bolt's not running in 100 years. I mean, we've got a long, persistent, hard job to do for people, and we're trying to just do that consistently, and hope people can retire, but with some dignity.
So, Rob, here's a what did you want to be when you grew up question.
Ooh.
I'd still ask you that. If not an equity analyst or a portfolio manager, what else?
Well, I'd say, so I must say, I'm kind of someone who's pretty much, I don't dream too much about the future, if I can. But as a little boy, I don't remember ever wanting to be like a fireman or a doctor or I just kind of concentrated on my studies, and I enjoyed my sport and and then as I mentioned, got a bit older, enjoyed finance and the thrill of the city and kind of numbers, a little bit nerdy, but yeah. So enjoyed that. But I think now what I quite like, I mean, you've asked like what's by a side book, a bit of gardening. Now that sounds weird, but I'd quite like to, I'm quite on sustainability, being able to feed people. So I think there's quite a lot you can do with clever design on let's say feeding people, and whether it be solar powered herb gardens, or that I'd quite like to potter around. I quite like pottering around in the garden, seeing things grow. Not that I would say I have very green fingers, but being able to do that. But I think there's something to be said for there's a world of abundance potentially out there if we can deploy technology right and make a difference in people's lives. I think maybe feeding people healthily would be quite a good attribute.
So how long before you grow your own potatoes and herbs?
Well, at the moment, I've got lots of herbs at home, a little bit of an orchard, not potatoes. Potatoes, like the risk reward is not so great there. But yeah, no, so it's quite fun. Like I wander around, and the question is, I've also got, I'm not very good at harvesting though. So I've had my cauliflowers have gone to seed, some of them, but when it's quite, I don't know, it's quite fulfilling when you can snip your cauliflower from your little garden
and cook it.
Yeah, cauliflower, carrots at the moment, most of the herbs, couple of interesting other things. So
Rob,
I like cooking, so I quite like cooking. So I suppose that's another way of being a bit creative in terms of. I hope you won't say we're creative with the numbers. We don't make them up in terms of that sense. We've got to be creative in the way we interpret them. But yeah, creativity and a bit of cooking I quite enjoy.
Rob, last question. Who's winning the match tomorrow between the All Blacks and the Boks?
Oh, I've got to say us. As an ardent Boks supporter, it's definitely going to be us. But I say I'm a little bit worried in the engine room. Not in that traditionally, we've had some very good lock pairings. We've got a bit of some newbies on the block there, and if they can stick at it, I think we'll have a good game. But it's always exciting.
Thank you so much for your time, and to the audience as well. Our next in the room is with Stanlib Asset Management, and we'll be chatting to Warren Buhai. Thanks, everybody.
INN8 is a registered trademark of Stanlib Wealth Management Pty Limited, an authorised financial services provider.